The Federal Reserve just held rates steady, and the market crashed anyway. That is not a contradiction. It is a warning signal. Because what the Fed said on Wednesday was not neutral. It was a message that the era of cheap money that fueled the greatest AI bull run in history may be coming to an end. And if you hold any AI stocks right now, you need to understand exactly what just happened and what it means for your portfolio. Welcome back to AI Assets, the channel where we break down the biggest and most important stories in AI and tech investing every single day. Today we are going deep on the Federal Reserve's June decision, what it means for Nvidia, Microsoft, the entire AI infrastructure sector, and the critical inflection point the market is now approaching heading into the second half of 2026. Let us start with exactly what happened on Wednesday, June 17th, and why it rattled markets so hard. The Federal Open Market Committee voted unanimously to keep the benchmark interest rate unchanged at 3.5 to 3.75%. That is the fourth consecutive hold since December 2025. On the surface, that sounds like a neutral decision. Markets were expecting a hold. So why did Nasdaq fall 1.3%? And why did AI stocks drop across the board? Because of what came alongside the hold. New quarterly projections from Fed officials showed that 9 out of 19 policymakers now believe rates will need to go higher before the end of 2026. That is a complete reversal from just 3 months ago, when the average Fed official was projecting a quarter-point cut this year. 3 months ago, the market was pricing in rate relief. Now, it is pricing in rate hikes. Fed Chair Kevin Warsh, who just took over from Jerome Powell and is running his first policy meeting as chair, made the situation even more uncertain by eliminating forward guidance entirely from the policy statement. In plain English, the Fed is no longer telling markets what it plans to do next. Warsh said directly, "I can't give you any forward guidance about what we're going to do next. The good news is we'll be meeting in 6 weeks." That 6-week window to the July meeting is now the most important date on every investor's calendar. The reason Warsh and his colleagues are hawkish is not complicated. Inflation is running at its highest level in more than 3 years. The Iran conflict has kept oil prices elevated for months, though those prices dipped sharply today on news of a diplomatic deal. And the U.S. jobs market is still adding over 170,000 positions per month, which means the economy is not slowing fast enough to give the Fed cover to cut. In that environment, nearly half the FOMC believes holding rates is not enough. And the market heard that message loud and clear. Now let us talk about what this means specifically for AI investors, because the rate story and the AI story are now deeply intertwined, and most coverage treats them as separate. The first and most direct impact is on AI stock valuations. The companies at the center of the AI boom, Nvidia, Microsoft, Meta, Broadcom, are among the highest valued stocks in the world. They trade at price-to-earnings multiples that are only justifiable if investors assume that future earnings are worth nearly as much as current earnings. That assumption only holds when interest rates are low. Here is the mathematics that matters. When the risk-free rate, the return you can get on a safe government bond, rises, the discount rate applied to future earnings rises with it. And when the discount rate rises, high multiple growth stocks get hurt proportionally more than low multiple value stocks. Nvidia trading at 45 times forward earnings feels very different in a 4.5% rate environment than in a 2% rate environment. That mathematical reality is not an opinion. It is how institutional money is managed, and it creates systematic selling pressure on AI stocks every time rate hike expectations increase. We already saw exactly this dynamic play out on June 5th before the Fed meeting. A strong jobs report pushed rate hike odds higher and triggered the worst single-day sell-off for Nasdaq since April 2025, a 4.2% crash in a single session. Nvidia fell 6.3%. Broadcom dropped 7.6%. Micron collapsed 12.7%. Approximately $2 trillion in U.S. equity market cap was erased in a single day, with more than half of those losses concentrated in semiconductor stocks. That was the market rehearsing what happens when rate fears dominate. Wednesday's Fed decision pushed those fears even further. The second sector to watch is private AI financing. We covered last week the Apollo Blackstone $35 billion private credit deal for Anthropic. That deal is structured with coupons tied to Treasury rates. If the Fed hikes, the cost of servicing that debt rises, and every future private AI financing deal becomes more expensive to structure. The era of near-zero cost capital that enabled the private AI funding boom of 2024 and 2025 is definitively over. Higher rates mean higher hurdle rates for AI investments, which means the bar for what counts as a fundable AI business just got meaningfully higher. The third implication is for the Anthropic and OpenAI IPOs. Both companies are targeting public listings in Q3 or Q4 2026. IPO valuations are extraordinarily sensitive to interest rate environments. In a rising rate environment, institutional investors apply higher discount rates to projected future cash flows, which compresses IPO valuations directly. If the Fed hikes by 25 basis points in September, as 9 officials now project, the window for a $1 trillion Anthropic valuation gets significantly narrower. That is a real and underappreciated risk for anyone holding pre-IPO AI exposure. Here is what the market is missing, and this is the angle you will not hear discussed on financial television. Everyone is treating the Fed story as a binary. Rates go up, AI stocks go down. Rates stay flat, AI stocks recover. That framing misses a much more important structural question. The AI boom is unique in financial history because it is being funded simultaneously by 3 entirely different capital structures: public equity markets, venture capital and private credit, and government investment. These 3 funding channels respond very differently to interest rate changes. Public equity markets reprice immediately when rate expectations shift. That is what we saw on June 5th and again on Wednesday. Fast, violent, and visible. Private credit markets, like the Apollo Blackstone structure, reprice slowly, with a lag of months or even quarters. The losses are not visible until deals are restructured or defaults occur. Government AI investment through CHIPS Act funding, the Stargate Initiative, and defense AI contracts is effectively rate insensitive. It moves on geopolitical logic, not discount rates. What this means in practice is that AI infrastructure is not going to stop getting built just because rates are rising. The government contracts and private credit structures that fund data center construction are already locked in. What changes is the valuation premium that public market investors are willing to pay for the companies that benefit from that infrastructure. The opportunity this creates is profound. The physical build-out of AI infrastructure data centers, power infrastructure, cooling systems, fiber networks will continue regardless of what the Fed does. But the public market stocks of the companies that supply those build-outs are now under selling pressure from rate fears. That is a divergence between underlying business reality and stock price that creates a buying opportunity for patient investors. Companies like Vertiv, which makes cooling systems, Eaton, which handles power management, and the major data center REITs are doing record business. Their order books are full. Their contracts are long-term. Their revenue is not sensitive to short-term rate movements. But their stock prices are being dragged down alongside the broader tech sell-off because institutional selling is indiscriminate in a rate shock environment. That divergence, strong fundamentals, suppressed stock prices, is exactly the setup that generates outsized returns when the macro environment stabilizes. So what happens next? Here are the specific catalysts and dates you must watch for the next 60 to 90 days. The first is the July 28th and 29th FOMC meeting. This is the next Fed decision, and it is now the single most important event on the calendar for AI investors. If inflation data between now and then shows any sign of cooling, particularly the June CPI report due on July 14th, the probability of a September hike drops sharply and AI stocks will rally hard. If inflation stays elevated or rises, September becomes almost certain for a hike and the selling pressure intensifies. The second is Q2 earnings season starting in mid-July. Microsoft, Meta, Alphabet, and Amazon all report in the last 2 weeks of July. These earnings will be the first true test of whether AI infrastructure spending is actually converting into revenue at scale. If any of the hyperscalers shows AI revenue acceleration alongside stable or improving free cash flow, the Oracle problem solved, it will overwhelm the rate headwind and push stocks higher regardless of Fed concerns. The third is the June inflation reports. The May CPI came in at 3.1%, still well above the Fed's 2% target. If June CPI due July 14th shows acceleration toward 3.5%, expect another violent sell-off in AI stocks similar to June 5th. That would likely be a buying opportunity, not a structural turning point, but only if you have cash available to deploy. Smart positioning right now means 3 things. First, do not panic sell AI positions into rate fear. The underlying demand for AI infrastructure is real and continues to grow regardless of short-term rate movements. Second, shift attention toward AI infrastructure suppliers with rate-insensitive revenue streams, power, cooling, and data center real estate, which are being sold indiscriminately alongside more rate-sensitive growth stocks. Third, keep meaningful cash available for the next 60 days. Between the FOMC meeting, CPI releases, and earnings season, there will be extreme volatility, and volatility in high-quality AI names is where generational returns get made. The Fed just reminded every AI investor of a fundamental truth that got forgotten during the bull run. Valuation always matters. The AI transformation is real. The demand is real. The revenue is real. But paying 45 times earnings for that revenue in a rising rate environment requires a level of conviction that most institutional investors cannot sustain under fiduciary pressure. The repricing that started on June 5th and continued through Wednesday is not the end of the AI story. It is the market searching for the right price for the right story. And investors who understand that distinction and position accordingly will be the ones who look back on this period as exactly the opportunity it was. AI Assets is here every single day to make sure you have the analysis you need to navigate exactly these kinds of moments. If you are not subscribed yet, hit that subscribe button right now and turn on the bell. That is all for today.